Hello everyone, this is Sharon Collier from ETC Tax, and today I'm doing a webinar on the issues for SMEs expanding overseas. So in fact this is the first of two webinars which will be looking at the following three key areas: structure and tax attribute management, trading and profit management, and finance and cash management. So how and where profits are taxed, particularly in relation to large multinationals, as I'm sure you'll all be aware, has been under a lot of scrutiny recently. For example, the OECD G20 BEPS project, which aims to create a single set of consensus-based international tax rules, which will both protect jurisdictions' tax bases whilst offering increased certainty and predictability to taxpayers. Whilst aimed primarily at large global organisations, such initiatives do also, to a certain extent, impact upon SMEs. Now, many factors have contributed to SMEs considering overseas expansion earlier in their life cycle than perhaps 10 or 20 years ago. Most recently amongst these, of course, will be Brexit. And when companies do look to expand, there are lots of tax issues to be considered. And today we'll be looking at some of the main issues. So today we'll be looking at structure and tax attribute management. And in a second webinar to be recorded later, I'll go on to look at trading and profit management and finance and cash management. So these areas are interlinked, but looking at them in this way can provide a useful framework for considering the issues involved. It can be a daunting prospect for a business venturing into an overseas market for the first time. And whilst I'm not going to be covering it in the webinar today, VAT will often be one of the first areas which needs to be considered. We won't be looking at this within the webinar now, however, we will be releasing a separate webinar shortly, which will look at the VAT implications of doing business internationally. So before we start to look at the overseas position in relation to companies, it's probably worth just quickly recapping the basis on which companies are assessed to UK tax. Similar to individuals whose basis of taxation is determined by their residence position, this also applies to companies. A company which is resident in the UK is normally subject to corporation tax on the whole of its chargeable profits on a worldwide basis, subject to relief for double taxation where appropriate. A company which is not resident in the UK will only be liable to UK corporation tax if it carries on a trade in the UK through a permanent establishment. Non-resident companies may also be liable to UK income tax on non-trading income, for example, property rental income. So getting back to our companies who are considering expanding overseas, some companies start by trading with a particular jurisdiction before moving on to carrying on a trade in that jurisdiction. It's important to understand the difference between these, as the tax implications will follow from that. So let's look at an example to consider some of the issues. So here we have UK Limited. UK Limited sells widgets. It's been doing so in the UK for a few years and has now been approached by a customer in country one who really wants a widget. UK Limited have agreed and dispatched the widget to the customer. So apart from VAT, the first consideration in this type of scenario is likely to be withholding taxes. So whilst it's unlikely in this simple example of distance selling, there could be circumstances in which withholding tax would come into play. Now this will depend on the jurisdiction and also the nature of the transaction. Let's assume in this case that the customer is an end consumer and that there are no withholding taxes. UK Limited makes a sale of goods to customer 1 for £100. No tax to pay in country 1, and UK Limited will pay UK corporation tax on the profit on the sale in the normal way. However, this will not always be the case. Let's just quickly consider a different example. So ABC build and supply customer relationship management software for business customers. They've been doing this in the UK successfully and growing rapidly. They install ABC software on customer systems, and ABC staff spend several weeks on customer sites installing and tailoring the software and providing training. They've now secured their first overseas assignment to implement the software for a business in country 2. So the considerations here are whether and the extent to which withholding tax would be applied, and again whether and the extent to which relief will be available in the UK for that withholding tax. So the relevant facts are that country 2 has a withholding tax which must be applied where services are carried out in country 2. The general withholding tax rate is 20%. However, there is also a double tax treaty between UK and country 2, which would provide a reduced withholding tax rate of 10%. So what we'll do is we'll compare the situation if ABC seeks advice and does some planning in advance, or secondly, if ABC were to go ahead with a transaction without fully understanding the implications. So let's assume that ABC has sought taxation advice and they structure things in the most beneficial way. So the gross contract value is £200,000, and this is split between a software and license fee of £100,000 and services of £100,000. The withholding tax only on the services element would be 10% on £100,000, which is £10,000, and the company would receive a net amount of £190,000. So how can we utilise the foreign tax credit? So in the UK, effectively we have to do a notional profit calculation. So let's assume that the notional profit on this contract is £50,000. The UK corporation tax, currently at 19% on that notional profit, would be £9,500, and the foreign tax of £10,000 can be used to relieve that UK tax. So in this case, we would reduce the UK corporation tax to nil, and there would be a small balance of foreign tax which cannot be relieved of £500. So let's compare this to the situation where ABC hadn't sought advice and they did no planning in advance of the transaction. So they issued one invoice only for a total of £200,000, which did incorporate services, and therefore the customer, to comply with their local legislation, had to withhold tax at 20%. So in this case, the customer withheld tax of £40,000, and a net amount of £160,000 was remitted to ABC. So similar to the previous example, the notional profit on this contract is £50,000, UK corporation tax of £9,500. Again, the foreign tax credit can only be used to relieve the UK corporation tax on that particular contract. So again, the foreign tax credit would be available to reduce the UK tax on the contract to nil. However, the balance of the foreign tax, which in this example is significant, £30,500, would not be eligible for any form of relief. So there may be some things that ABC could do to rectify this situation afterwards if they hadn't done it in advance. For example, they might be able to go back and split the contract, reduce the withholding tax in that way, and they may also be able to, after the event, claim the reduction in withholding tax to the treaty rate. So certainly there would be a significant cash flow disadvantage and also potentially a real cost disadvantage. So this is why it's important for companies to understand the implications before entering into transactions overseas. So that was the consideration of withholding taxes. Let's now quickly go back to our first example company, which is UK Limited. So following the sale to the first customer in country one, the customer recommended UK Limited products, the widgets, to their friends, and orders from country one started to grow. UK Limited then decides to open a warehouse for use as a distribution centre in country one. So they ship goods in bulk to the warehouse and then use that stock to fulfil orders in country one. This would reduce their overall shipping costs significantly. They utilise the services of a logistics company in country one, which will manage shipping of orders from the warehouse to individual customers. So that's the middle slice there. So business in country one continues to thrive, and the company then decides to take on an employee. The employee is tasked with growing business in country one, undertaking market research and creating a bespoke offering which would appeal to customers in country one. They'll conclude contracts for sales, as well as dealing with the shipping of goods and administration. So somewhere in this life cycle, UK Limited will have achieved a permanent establishment. So they'll have gone from trading with to trading in country one. And what does that mean for how they will be taxed? So the UK's definition of permanent establishment is based on the OECD model. And most of the UK's double tax treaties will also follow the OECD model and therefore have the same definition of permanent establishment. So the OECD updated Article 5 to the model treaty in 2017. Although the article itself is only 2 sides of A4, the commentary on Article 5 in that 2017 update ran to 47 pages. So this gives some kind of indication of the complexities involved, and we certainly won't be looking at all of those details today. However, it's useful to bear in mind what the concept of a permanent establishment is for. And as noted in the OECD commentary, the main use of the concept of a PE is to determine the rights of a contracting state to tax the profits of an enterprise of the other contracting state. The contracting state cannot tax the profits of an enterprise of the other state unless it carries on a business through a PE situated therein. So in our example, does UK Limited have a PE in country one? So the term permanent establishment includes, especially, and this is from the treaty, a place of management, a branch, an office, a factory, a workshop, and a mine, oil or gas well quarry or other place of extraction of natural resources. And it will also include a building site or construction type project if it lasts for more than 12 months. There is also some clarification as to what a permanent establishment should be deemed not to include. I'm not going to go through all of these, you can see them on the screen there, but these are generally where the activities are auxiliary to the main activity or preparatory, so preparing to actually trade and have a permanent establishment in a jurisdiction. So looking at UK Limited, so you can probably see that by the last stage of this company's journey, where they've got the warehouse, they've got an employee, an office, that they will be treated as having a permanent establishment in country 1. In the intervening period, there's more factors to be considered, and it's perhaps not quite as clear. So the types of factors you might want to look at here are any contracts concluded in country 1? So does the logistics company have any authority to negotiate contracts, sign contracts in the name of UK Limited? Whether the logistics company is in some way related to UK Limited could be vital as well. A few years ago, there would probably have been a strong argument that there was no PE in this scenario. However, the recent changes are likely to mean that it is actually more likely now that a permanent establishment would exist. So once we've considered whether a permanent establishment exists, then what does that mean for tax purposes? So Article 7 of the OECD Model Treaty looks at the taxation of PEs, and it states that the profits that are attributable to the permanent establishment are those profits that it might be expected to make if it were a separate and independent enterprise engaged in the same or similar activities under the same or similar conditions, taking into account the functions performed, assets used, and risks assumed. So there are different ways in which you might look at what the profits attributable to the PE are. So in our example, sales generated in country 1 with an allocation of direct and indirect costs relating to those sales might be appropriate. If the country 1 employee didn't have any authority to conclude contracts, then a cost plus calculation based on the costs in country 1 might be appropriate. So we've looked at when and whether a permanent establishment exists, how PEs should be taxed. So then we need to look at if UK Limited pays tax in country 1 on the profits of the PE, what does that mean in the UK? So double tax relief can be claimed on the foreign tax paid in relation to the permanent establishment, and there is also possibility of carrying back or carrying forward unrelieved foreign tax in this scenario. So that differs from the withholding tax that we considered earlier. It's also possible to make an election to exempt the permanent establishment from UK corporation tax, and the statutory references for that are shown there. This would be advantageous if the PE is profitable and the rate of overseas tax is lower than the UK corporation tax. However, it is important to consider this election very carefully because the election applies to all permanent establishments of the company, and it is also irrevocable. So you need to consider not only the situation today, but whether it's likely that you may have other permanent establishments in the future that might have a different set of tax attributes. If the company is a small company, then the exemption will only apply to permanent establishments in countries that have double tax treaty with the UK containing a non-discrimination clause. So we've very quickly looked at the issues for a company that started trading with an overseas jurisdiction and moved on to trading in that jurisdiction. But in other scenarios, companies will just look at establishing a presence in another jurisdiction from day one, and the consideration as to what that entity will take, the form that presence will take, could be important. So the two main types of structure that you'd be looking at would be either a subsidiary company in the jurisdiction or a branch taxed as a permanent establishment. So the slide here looks at some of the main considerations and the differences. So a subsidiary is a company, has a distinct legal personality, whereas a branch is not a separate entity and is effectively part of the head office company, if you like. We look here at requirement for accounts, audit, tax base, and also the other thing to think about is exit. So in a lot of cases, the decision will be impacted initially by commercial factors. It could be that there are regulatory requirements in the overseas jurisdiction which demand, for example, a particular level of capital, and that might be more easily satisfied using a branch structure where the parent company capital could be taken into account. But where there is no particular commercial pressures for one form or another, then tax issues may well influence the decision by taking into account the local country's tax position for both branches and subsidiaries. So, for example, you would need to think about, is there any difference in tax rates between a branch and a subsidiary? Can profits be remitted back from the country to the UK in the same way? So a good example of this is the US. So the US has a branch profits withholding tax, which is reduced to 5% in the UK-US double tax treaty. But dividends paid from a US subsidiary to a UK parent company, where the company owns more than 80% of the capital for more than a year, before the dividends is paid, would not suffer any US withholding tax on the distribution to the parent company. So that could create a difference there. Another consideration is whether the overseas venture will have losses in the early years, and how and whether they can be relieved against group/UK holding company profits. So as well as the overseas tax considerations, the UK tax position will also need to be considered, as well as the interaction between the two. So, for example, the UK company will be taxed in the UK on the profits of an overseas branch, with credit given for the foreign taxes paid on those profits, unless it elects to exempt the profits and losses of the branch. Whereas the UK parent will not be taxed on the profits of the overseas subsidiary unless the profits are reallocated under transfer pricing rules, or the structure falls within the CFC, controlled foreign company rules, or potentially within the diverted profits tax rules. If the venture is profitable and a branch is taxed at a lower rate than a subsidiary, then this potential advantage is effectively eliminated by the UK tax on the profits of the branch, particularly where dividends paid by a subsidiary would be exempt from UK tax. However, the UK tax position of a branch is an advantage where startup costs are expected to generate losses. The net losses of a branch will usually be immediately available to the UK company to set against UK profits, and potentially be group relieved as well, where no election has been made to exempt the profits and losses of the branch. In contrast, the losses of a subsidiary overseas are harder to access, so the availability of loss relief will be a consideration in that circumstance. Most jurisdictions, including the UK, permit branches to be converted to subsidiaries with minimal tax charges, although this should be considered as part of the initial planning to ensure that it is the case. So where conversion is not tax disadvantaged, it'll be possible for a business to use a branch for the early loss-making years in which the business is developing overseas, and so access those losses for UK tax purposes, and then incorporate the overseas branch into a subsidiary to be able to take advantage of the dividend exemption. So you may want to consider branch or subsidiary on day one, but also depending on whether the overseas business is likely to be profit or loss making, look to incorporate and move to a subsidiary further down the line. Or in some jurisdictions, it would be worthwhile to have a subsidiary from day one. So that is the end of the topics that I wanted to consider in this first webinar. Thank you very much for listening today, and hopefully you will want to tune in to the second of the webinars on expanding overseas, in which case I'll look at the two areas outlined earlier in the presentation. Thank you very much.